Hello everyone, welcome back to Neffy Cat. We're so glad that you can join us today. Today I want to talk about some simple rules for trading in the stock market, and this goes into other things too, like crypto or other type, even into real estate loosely. But I thought you might like to learn some of the simple rules that those with wealth follow. One of the first ones, this is a mistake a lot of people make too at first, is that they don't diversify their portfolio. Remember that you need to buy into more than one area, and ideally even more than one type of stock. Yes, just like this little kitty. He doesn't just eat one thing in his life, he eats a diversity of things in his life. As long as it's edible for him. Well, the same for your money. Don't ever just put all your money in one spot, in one stock. One of the things you'll hear people say too is don't just put it all into savings, because savings have a very, very, very small rate of return. If you diversify your portfolio, then when one stock is starting to go down, a lot of times another one is going to be doing better. And so that's something really important to think about. Also, a very important thing is to have a clear exit and entry plan. This is a wonderful symbol of having a good exit and entry plan. Yes, it is. That is really super important, because sometimes people might see a stock running and think, oh, I'm just going to buy into that. And then they won't know that that stock perhaps just had an FDA approval or a catalyst that made it run. And right after that, let's say it's in pre-market, and right after that, it's going to crash and they lose all the money plus that they were trying to put in. It's very, very important to have a clear entrance and exit plan. And one example of that is having stop losses set. When you are exiting the market, when you're exiting a stock, it's good to actually set the stop losses or buy limits. We'll go into all of those things in future videos, so that in case you make a miscalculation, or in case the catalyst flops, or in case the market is just red, or the sector is falling overall, you won't be caught holding a bag. Another important thing that a lot of newbies fight is to make sure that you backtest your strategy. Backtesting is going on and trading with paper money. There's sites like Thinkorswim, Webull, and others that have that make the ability. Also, Investopedia, I believe, does too. But they make you give you environments so that you can test things out. You can test your theories and strategies out in the market and see how you do before you ever put real money in. Another thing this one's a big deal too, and this is one that I haven't always listened to and should have, that's to use a simple strategy. Work on one method and then get used to that and stick to it, especially in your early career. Some people, for example, like to do scalp trading. Some people like to do earnings plays, and they buy in when the stock cliffs down and then sell off when it goes back up, which often happens, not always, in earnings plays. But it's really important to set and, to know what your strategy is going to be and to use a simple one. Also, always manage your risk. Study, it helps with stop losses like I mentioned, but also to study technical analysis and the fundamentals of a company. Does it have a good working plan? Is the business model good? Does it have good growth potential? What are its earnings like? Does it have real profit, or is it still using borrowed money? Is it high in debt? That's a really important one. Check the debt to asset ratio. We'll go into those in other videos as well. And especially though, you need your fundamentals when you're going to do midterm or long-term swing trading, or, getting into investing itself. And another good thing to think about is to get to know the stocks that you're interested in trading. Look at their stock history. Look at the way that the price action has happened in the past, because it can repeat itself. Sometimes, for example, if you have a channel trade going, if you're a person that likes to do channel trading, you'll buy in when it's low and sell off when it's high within a channel. Then you want to make sure that you know the stock well enough to know if it's a good probable chance it's going to continue in its channel. And then this last one I want to say sounds very funny, and you've heard this, I'm sure, in other areas, but it's called KISS. Keep it simple, stupid. Use simple strategies that are going to work for you, and don't just get there and try to get all complex. One thing that can happen on YouTube, we have all sorts of wonderful advisors and, well, people that share their strategies with us. But sometimes it can get very complex, and you may start wanting to go into a new strategy that works for somebody else. The stock market is something that's a big playing ground, so to speak, a big field in the market, and each person individually trades and has their own unique style. You can have 200 people trading the same stock even, and they'll all trade differently. So that's a really important point too, and you want to keep it simple. Find one that really does work for you and your personality type. If you're a person who doesn't like to sell off quickly, then you're probably not going to want to do day trading. And if you're a person who can't stand waiting and who likes to see your profits right now, then you might do really well with scalp trading. So keep those things in mind, and I just wanted to share that with you. This is some of the early stuff that I learned too, and it really made a big difference in my life. Most of us don't go into the stock market very wisely, and the more knowledge you can go in with before you trade, the better. I knew one person that put all of their money that they had from a house sale into one stock. It was an FDA approval stock, and they were convinced that that was going to get approved, the item was going to get approved, and it didn't. So they put all of their money in one place. They hadn't diversified their portfolio at all. They didn't have a clear exit and entry plan because they didn't recognize that FDAs, even if it had been approved, they usually take after the catalyst, after the reason why everybody is going into that stock. And it's very important for you to know those things so that you won't make those mistakes. It's much better to learn, to have a simple plan, and to back test it, and to make sure that it's going to work for you. Get to know the stocks or the stock. You can even just trade one stock. There are some people who really literally only trade one particular stock. Sometimes you'll even have like people that trade the reverse ETFs or reversed funds, inverse funds of each other. We'll go into all that in future videos. And they'll just trade two different ones. So they might trade one if the stock market's going up that day, or another if it's going down that day. All right. So anyway, that really matters. And I just wanted to share all that with you, and I really appreciate your time, and so does he. Please don't forget to take those paws if you like this content and hit that like button, and you can push the subscribe button and the notification bells so that you can see all of his videos. Thank you all so much for sharing today with me. I look forward to seeing you in the next video, and have a wonderful day.